Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It is Teaching Tech Tuesday. Let's talk about different types of trading styles and different types of trading strategies. If you've never been exposed to this stuff, or if you're a newer trader, I think this is very valuable to give you some idea of what other people are doing, what other people's success might look like. If you've not done so hot, here's some ideas for you and what to try. Everybody has to find their specific strength, identify their weaknesses early on. Generally, most people fresh to trading are YOLO gambling, basically, right? Which is called scalping. Very low time frame, take a lot of trades. It's a casino, right? Typically, this is high leverage, lots of transaction fees, very active. Forcing trades is really what I see it as. Very quickly early on, I realized this wasn't for me. Okay, so very quickly early on, I realized I want set and forget it. I want trend trading. I want breakout trades. I want to identify well in advance what my trading strategy would be. And I hope I illustrate that on the channel in the videos. Usually this is the decision tree. This is if this, then that. Usually within the week, at least, I have some sort of viewpoint with actionable items on what to do that help guide my own trading. But what I'm not doing is going down to the 15-minute or the 5-minute, right, and looking at whatever. I think even more people probably fall into the day trading category. Again, probably high leverage, maybe, mix in options with this as well, derivatives, futures, whatever. Not that there's anything wrong with any of this. I just think most people, on average, who are unsuccessful traders would be much more successful if they stuck to the right side of this table, if they stuck to swing trading and position trading and avoided scalping and day trading like the plague. I feel a completely different mindset where you are, you're relaxed, you're moisturized, you're unbothered, right? You're in your lane. Things can happen and it just doesn't matter. I have a lot of discussions with people about stop losses and do I move it here? Do I move it there? What do you do in your sleep? Do you put it on the order book? I don't really worry about that stuff because I'm all the way over here, right? I'm so confident in the types of breakout trades I take, the types of trend trades I'm looking for. I don't really sweat massive leveraged positions that could go against me or get liquidated. Like, that's just not part of my system, okay? It's okay that that is part of your system if that is part of your system. But I'm just saying there's a different way to do things if you're on this high octane roller coaster ride all the time. I think a lot of us have a hodl stack, which would qualify as position trading, rarely active. A lot of us have coins that we've held for a decade. I'm not going to say who, but there are some people who have held coins for a very long time, right? And they have a number in mind, and that number has not been hit yet. And the investment thesis, which they may or may not have identified initially at the time, is still very much active and playing out and favorable to the hodl stack. So there's nothing to do there, right? Again, people think you're a trader. There's always stuff to do. I got to look at all these indicators and listen to all these macro podcasts, and it's fun. It gets me through the day. But rarely does, a macro analyst give me any actionability on the trading front. Looking at swing trading, that's recently probably where I've fit in a little bit more. If you are on leverage, which a lot of people are using leverage, nothing wrong with that. I find that swing trading, waiting for setups, acting like a predator stalking its prey, right? I'm not desperate. I'm hungry, but I'm not desperate. And I'm just waiting for specific setups that I know have a historically successful risk reward profile. That's it. So there are some days, most days probably, where I do next to nothing, right? I'm either in a position, just letting it play out like I am now with this Bitcoin long, or you're waiting for your setup to occur, right? Trend trading also probably within the swing trading category. Higher time frame, you're doing less. You're letting the market come to you. You're not panicking about FOMO trading. You're either doing a mix of dollar cost averaging, you're doing a mix of moving bids around, moving asks around, fairly relaxed, okay? This all would qualify as active trading, by the way, versus passive trading, but other considerations would be, how much time do I have? If I have 6 kids and 3 wives, I'm probably not going to have a lot of time to stare at the screen, okay? So keep that in mind, because again, I know people who just like to trade on the weekends or whatever, and they pull up a chart on the 5 minute or the 1 minute and they think it's DraftKings. That's fine. Look, these people are part of the market. I have nothing wrong with that. If you're successful, great. In some respects, it's better that these people are unsuccessful. For the successful people, that's just what makes a market. But I'm telling you, there's a better way to do things. Obviously, risk plays a role here. If you are a day trader, who in traditional markets, this makes a little bit more sense, but the pajama traders, okay, where they buy the close and sell the open, or you're trading only through the day specifically, and then at night you go net neutral. You basically go to cash in after hours or on holidays. That doesn't really work for crypto because it's 24/7. But I know there are a lot of people who do that, and that's fine. If that works for you, great. Volatility also something to consider here. Scalpers and day traders will love volatility. Position traders don't really care. Swing traders want volatility at specific times when they want the volatility, not necessarily consistently. But if you're actively trading, volatility is generally what you're seeking out. You're generally seeking out large movements you can take advantage of. Something that deserves its own video that I never talk about is the emotional, psychological aspect of trading. I'll save that for a separate video, but I know there are a lot of people who just cannot hold on to a loss, cannot hold on to a win, cannot sleep in a position, cannot size up correctly or appropriately based on the risk. What else? You find out who you really are when you start to win or lose, gain or lose a bunch of money. Okay. To me, emotionally, there's no higher high and no lower low in my life than trading. Just none. Nothing compares. Okay. For a lot of us, that's why we're here, because we get to feel something. Okay. But the emotional aspect is massive. So if you are a day trader or a scalper and you can't handle your emotions and you're just losing, slow it down. Okay. Just slow it down. Move to trading, higher time frames, have a massive hodl bag, right? Save yourself from yourself and just get out of your own way and let it take course, right? If you're bullish on something and you believe in it for XYZ reason, fundamental, technical, or otherwise, don't rely on the 5 minute to make those decisions on steering the ship in a different direction. It's also worth considering fees and taxable events. If you're on a tax advantaged account versus a non-tax advantaged account, if you're trading on a DEX or a centralized exchange in crypto, those are all taxable events. If you're going in and out of stable coins, those are all taxable events. If you're trading miners or MSTR or coin in a Roth, right, you may have a little different viewpoint on the market based on how active you trade that. And that's all the more reason to have these allocation buckets like I talk about. Like, again, for the most part, crypto natives have hardware wallets. They have a hodl stack, whatever, right? They have something that they don't want to lose on an exchange. Then a lot of people trade a smaller percentage of the hodl stack that they put on a centralized exchange or a DEX or a software wallet, right? So you can walk and chew gum at the same time. I'm not saying you shouldn't ever scalp, okay? I just don't care, because I feel like the risk reward there just isn't typically where I want to be. But to me, the risk is massive on the lower time frames, and the risk is considerably less on the high time frames. I don't want to say easy mode on the high time frames, but if you're trading spot once a month, twice a year, I mean, you're doing okay, right? There's enough volatility in crypto or crypto equities or legacy crypto or whatever, where you can really, really take your time there with entries and exits if you want, and just slow everything down. Half the reason why I doubled the cloud settings is to just slow everything down. Everybody's just way too fast. I'd rather have much slower signals that are generally correct, have a higher hit rate, than worrying about lower time frame stuff. So that's my soapbox for low time frame stuff. This is trading styles. This kind of mirrors trading strategies a little bit. These are all hedge fund strategies, effectively, globally, including crypto. Most of this stuff isn't applicable to crypto. Most retail trading crypto is effectively a long-only hedge fund, okay? Generally, they, or you or me, never short anything ever. You're either in cash or you're fully deployed long, right? There's generally not a mix of some sort of advanced strategy. That is changing pretty significantly with the advent of DeFi, with staking, with restaking. with futures, with options. So we are getting a taste over the past decade, really, of this different type of stuff where it's not just all about directional long short. It's not even necessarily discretionary. There's even passive stuff mixed in there. But I think it's just important to take a broad view of what you could even be doing here, right? Because again, if you're not great at the long side, there's other stuff you can do, okay? Not saying you should, but there are other options. Lots of people, they just stake and they hold crypto. That's great, right? That's basically a yielding risk strategy with some directional risk in there. The crypto hedge fund slice fits into the niche strategy bucket. There's commodity traders, credit, equity, event driven. I'd say we are also a little bit event driven, right? When we're talking about ETFs, when we're talking about transitioning from proof of work to proof of stake, when we're talking about airdrops, when we're talking about exchange listings. I mean, that's a different type of event driven than they're referring to here, but a lot of people, that's what they're trading around is an event, right? Macro, we're not really macro, but we kind of are. We're kind of getting more into macro. But realistically, if you're a crypto hedge fund, you're probably not doing any of the other things. And any of these other hedge funds probably aren't touching crypto. And if they are like 10% or less of global hedge funds. This was data from Coinbase from Preqin as of last year. And we can see the AUM growth was pretty significant on a year over year basis from 21 to 2022, despite 2022 being as horrible as it was, right? You can also see how small we were. This isn't just crypto, by the way. This is any niche strategy, but at that time, how small crypto hedge funds were relative to everybody else. So we're just this tiny baby relative to global hedge funds. Equity strategies, that's $1 trillion. It's probably way more than that now, but compared to 62 billion at the time, we were nothing. And then again, back to this idea of crypto specific hedge fund strategies. Okay. Many people are aware of what this stuff is, but they may not have seen like a name put on it, right? So we have the liquid stuff, which is easily bought and sold. You don't have an issue, for instance, going to exchange and selling anything in like the top 500, right? Bitcoin, ETH, whatever else. There are plenty of places you can sell that or buy that if you want to. There are passive places where you could DCA like River. We have ETFs now. We have global ETPs. There are funds and trusts and pink sheets and all this other stuff. All that stuff for the most part is liquid, right? You have arbitrage as well in there, which is typically where something is cheaper in one place and more expensive in another, and you are the middleman taking the difference. Liquidity provision would be DeFi in my mind. And then the illiquid stuff is mainly venture capital, equity investing, or a mix of the two. Realistically, over the past 5 to 6 years, it's been early stage token investing. Get the biggest slice as cheap as you can, unlock that as fast as you can, dump it on retail. Okay, that's why I do not like crypto VC generally. And I do not like any project that tries to dump tokens on people for that exact reason, because I know somebody bought that token for pennies on the dollar relative to what people are trading it on an exchange. If we dig one slice down, this is liquid crypto fund strategies. And again, most of us are somewhere here. Most of us are long based, long biased, event driven. I don't think most people, I feel like, have never actually taken a short in their life in crypto. I mean, most people are long only, which is totally fine. We've only been realistically bearish for like 3 years out of 10. Okay. So like that makes more sense to be long biased than have long short in your strategies, but it's nice to know how to short, when to short, where to short when you get there, right? But if you're a terrible trader and you love crypto, right, and you don't just want to hodl, there's other stuff you can do, right? Liquidity, market making, DeFi, market net neutral stablecoin lending, okay? Like you can go as net neutral risk down the spectrum, not directionally anything as you want. It's there, it exists. Most people don't want that. Most people want the risk and the volatility, but folding that into the mix of your trading strategies might be highly advantageous over the long run. And tons of different ARB strategies, which for the most part, retail isn't really participating in because those are generally more complex. Liquidity provision, pretty easy for DeFi. There's cash and carry trades for futures. Generally, retail isn't market making either. But just to give you some sense of what's going on there from trading styles and trading strategies, if you're sort of looking around for, is there something else I can do to be successful or to improve my edge or to think about this market a little bit differently? Those are your options. There's tons of stuff you could do. So the number of hedge funds per year has generally followed price. I don't have 2023 numbers here. This isn't size of the hedge fund. This is just the number. My guess is this is down probably pretty considerably, as most probably fizzled out in 2022. This is Galaxy Digital's composite hedge fund index for crypto relative to Bitcoin. So this is kind of important to look at if you are thinking about giving somebody money, because if they are not consistently outperforming buy and hold, well, why bother, right? You're paying 2 and 20 or 1 in 10 or 0 and 30, whatever it is, for them to run your money when you're better off just buying and holding, right? Based on the index, it looks like most hedge funds not worth it generally, right? They may protect your downside, but they certainly aren't going to give you room to run in months like January and March 2023, when generally these hedge funds are out of position. And I'm assuming these hedge funds this year, January and February, are massively out of position. Trading a smaller stack allows you to take more risk, allows you to do things a little loose that maybe somebody with an investment committee wouldn't be able to do. So keep that in mind. But you'd obviously want to compare the hedge fund you're talking to or investing with or whatever, or yourself relative to the index, right? Again, if you're not beating buy and hold, what are you doing trading? And if you're beating crypto hedge funds, then you're doing great, right? So if you're beating both, that's where you want to be, which is statistically very hard to do. This is Galaxy's data on sizes of these hedge funds. And again, it's just interesting to see, like, are we growing? Are we shrinking? What types of strategies are seeing growth? I don't have a great longer term look at performance relative to buy and hold. There's some charts out there that show, net neutral strategies are great because funding is generally high in crypto. And there's always some place to provide liquidity. Looking at AUM relative to that Coinbase number in 2022, AUM kind of stuck in the mud here at 60-ish. So we're not really seeing a lot of pickup on the liquid crypto side of things, which isn't terrible. I think at this point, we're probably seeing the venture stuff start to pick up a little bit from the ashes. And we're starting to see TradFi, legacy trade, CME, trade ETFs, right? So it's not going to be a crypto native story anymore. It's going to be a global hedge fund story. This is the venture part I'll talk about for 2 seconds. This is DeFi Llama's monthly raises for projects. Obviously, you can see FTX effect in here, 2018, ICOs, and we're still very much in the doldrums of the VC bear market. It's hard to want to give people money as a VC if rates are as high as they are. The cost of capital increases significantly. That puts increased pressure on VCs. It's harder to raise the money in the first place. It's harder for them to deploy the capital to the correct projects to make a return that's worth it. But that's how it should be. It should not be zero rates, throw your money into every zombie company or anything and see what sticks on the wall. That generally doesn't produce the best companies historically, right? So I would argue we actually don't want to see the craziness we saw in 2021, 2022 ever again. Clearly that didn't work out so well, okay? A lot of this went to FTX. Yeah, they're not around anymore, right? They were criminals. They were doing criminal activity. If we look at the VC funding, also just down significantly. And again, you can see how crazy this got. In the zero interest rate environment, you get people throwing money at all sorts of risky stuff. And then it's the VC's job to go and find places to deploy this. And so they just find stuff, right? Like, it's not necessarily great projects that are getting funded. It's just there's so much money floating around. The quality of the project is less important. But that is down considerably in 2023 when you're seeing almost no raises whatsoever from TradFi or crypto. If we look back and we dial it back historically, the best companies are always built in the bear market. The best companies have always survived the bear market. That's why they say the bear market is for builders. Kind of cringy, but it's true. Very much survival of the fittest with these businesses and funding. Lastly, let's just look at the global change from 22 to 23. Fund count down by half, amount raised roughly down by half. US fund count down by a third, total raise down by a third, and global fund count down by a fifth, with total amount raised down significantly. Okay, so ideally the types of companies that emerge, that are being built now, that are being funded now, that are being discovered now and last year, are significantly better for the ecosystem than companies that have emerged in 2022 and 2021. And I mean, I can think of all these Web3 companies that are just for sure going nowhere. Okay, there's just no chance that most of these make it over the long term. So look, if you're struggling with trading, I would identify a different trading style. I would slow things down, because I'm guessing if you're struggling, you're doing things too fast. And then the rest sort of falls into place slowly over time. This takes time. That's the other thing. No one's a great trader overnight. Everybody's got to touch the stove and get burned. Everybody has to pay their tuition. You're going to lose money. So don't trade your lunch money. None of this is financial advice. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.